Good day, everyone. This is Bichelin. Today, we will be summarizing the market conditions observed throughout August and speculating on how September might unfold. Let's dive into today's analysis. We'll review the economic indicators released throughout August and categorize them into positive and negative signals to make predictions for September. As the economic indicators are listed, don't feel overwhelmed. Follow along with the video, and I'll provide a clear summary and explanation. On August 1st, the PMI and ISM PMI indices were released. Both indices represent the Purchasing Managers' Index, PMI, for the manufacturing sector. To simplify, these indices are based on surveys of purchasing managers in the manufacturing sector, asking, "How's business?" The results are quantified into an index. The key difference between the two indices is that PMI is conducted by private firms, while ISM PMI is conducted by the Institute for Supply Management, a government entity. If the index value rises above 50, it indicates that manufacturers are faring well. If it falls below 50, it suggests that they are struggling. Both the private PMI and government ISM PMI were below 50, indicating that manufacturers are finding it difficult to sustain their businesses. Next, on August 2nd, the U.S. average hourly earnings were released. The actual figure came in lower than the forecast of 0.3% at 0.2%. This suggests that the growth rate of wages is slowing, implying that individuals may have less disposable income, which could dampen consumer purchasing power and, subsequently, inflation. On the same day, the non-farm employment change also significantly missed expectations. This indicator tracks the number of new jobs created outside of the agricultural sector, and the decrease indicates that companies are hiring fewer workers, signaling difficulties for businesses. As expected, the unemployment rate rose by 0.2% above forecast levels due to these conditions. The non-manufacturing and service sector purchasing managers' indices released on August 5th showed that, unlike the struggling manufacturing sector, companies in the service sector are still faring well, with both indices staying above 50. On August 13th, the Producer Price Index, PPI, came in below expectations, with a decrease of 0.1%. This suggests that the cost of production is declining, which could lead to lower prices for goods as they enter the market. On August 14th and 15th, various Consumer Price Index, CPI, measures were released, all aligning with forecasts, indicating that inflation is stabilizing. Additionally, retail sales exceeded expectations, suggesting that as prices stabilize, consumer spending is increasing. On August 22nd, indicators once again showed a weak manufacturing sector and a strong service sector. Meanwhile, existing and new home sales indices were strong, indicating continued demand in the real estate market. Finally, GDP data, which measures the economic growth rate of the United States, showed robust growth, suggesting a thriving economy. The PCE price index, a key inflation gauge, remained stable, indicating that inflation is not increasing further. Now let's simplify and organize these indicators to summarize the economic conditions in the U.S. for August. The manufacturing sector is struggling and may need support. Meanwhile, the service sector is thriving. Prices are stabilizing, but the rise in spending could signal a potential for inflation to resurface. There's still significant demand in the real estate market, suggesting a risk of a potential bubble. Given the potential for bubbles in both real estate and inflation, if the market expects an aggressive rate cut of 0.5% to 0.75%, it could spark a frenzy in the real estate sector, a situation that Fed Chair Powell is particularly sensitive to. Therefore, based on last month's data, a significant rate cut seems less likely. A 0.25% rate cut appears to be the most probable and appropriate course of action. Looking at recent U.S. presidential election polls, though there are variations between survey organizations, most show Harris leading. Given this, it's unlikely that the Democratic candidate Harris would take the risky step of a significant rate cut before the election, potentially triggering market instability. Instead, they are likely to prefer a more gradual approach. Short-term U.S. Treasury yields have been stable for about a year, but are now starting to decline. This suggests a high likelihood of a smooth and gradual rate reduction. While many might hope for an aggressive 0.5% to 0.75% rate cut, I believe that a steady 0.25% cut in the current situation could trigger a substantial market rally. Let me show you an unfamiliar indicator. Highlight the CCC High Yield Index Option Adjusted Spread. This indicator measures the spread between high-risk, high-yield bonds and more stable bonds. A high value suggests that risky assets are popular, indicating market instability. Conversely, A low value indicates a calm and stable market. Historically, this spread spiked during global financial crises, such as the 9/11 attacks, the Lehman Brothers collapse, and the COVID-19 pandemic, while it tended to bottom out during periods of strong market rallies. In essence, a stable market without turmoil tends to lead to sustained, strong upward movements. Currently, this spread is trending downward, although there was a brief spike on August 1st due to concerns over the unwinding of yen carry trades and fears of a U.S. recession. However, it's now gradually settling back down. Rather than risking market turmoil with an aggressive rate cut, a gradual 0.25% cut seems much more beneficial for a sustained upward market trajectory. Let's think about this logically. Market players are waiting for individual investors like us to start buying. If there's a sharp 0.5% or 0.75% rate cut in September, how would you feel until the next rate announcement? Would you expect another sharp rate cut next time? Are they going to raise rates again? Or would you be anxious every time economic indicators are released, worrying that the rate cut might be reversed or that negative news could emerge? In contrast, with a gradual 0.25% cut, you'd likely feel more at ease, anticipating another small cut next month. The economic indicators wouldn't cause as much anxiety, making it easier to continue buying steadily. If you plan a grand event, like renting a yacht for your 100-day anniversary with your partner, future anniversaries could feel daunting. But if you simply give a single rose for the 100-day anniversary, smaller gestures in the future will still have a significant impact, benefiting your mental well-being. But once the market receives a substantial gift, there isn't much to expect unless an even bigger gift follows. Considering human psychology and market sentiment, a consistent 0.25% reduction is likely to have a more positive impact on asset markets. To summarize, the economic indicators in August were fairly decent, showing no signs of a major shock. If interest rates are reduced smoothly, the market is expected to gradually enter a recovery phase. So, what are the future prospects as we move into September and further into October and November? By analyzing the RWA data, we can find some clues. Yes, the RWA you're all familiar with. This includes platforms like Ondo, Centrifuge, and Maple, among others. The image you see here represents the value data of the tokenized government bond market. This market facilitates trading in government bonds using RWA technology. The total value of circulating crypto bonds is approximately $200 million. We see the average yield of the currently circulating crypto bonds, which is 4.94%. The average maturity is 0.1 years, indicating that most of these bonds are short-term, typically maturing around 1 month. The key takeaway here is the recent 7-day holder trend, where 69.5% of holders have cashed out. This suggests that as interest rates are expected to decrease in September, the appeal of holding these bonds diminishes, leading holders to sell and realize profits. We can conclude that bond traders have anticipated the rate cut and acted accordingly. Now let's look at the next image. This shows the scale of private credit facilitated by RWA. Clearly, the volume of loans is increasing rapidly. Where is this borrowing coming from? The colorful segments represent different platforms performing RWA operations. The overwhelming blue section corresponds to Figure. Figure is a platform that provides cryptocurrency loans secured by residential and commercial real estate. The data shows that loans are continuously increasing, with around $20 trillion in mortgage-backed loans being issued. Borrowers are paying interest rates of around 9% per year while purchasing cryptocurrencies. To summarize, the trend shows that government bonds are being sold off in anticipation of a rate cut, while there is a surge in high-interest mortgage-backed borrowing to purchase cryptocurrencies. This could indicate two things. First, there's a strong belief that the value of the collateral won't decline, real estate. Second, there's confidence that the returns on cryptocurrencies will outweigh the 9% high-interest risk. We can draw additional insights from this data. The coins we frequently encounter in exchanges, such as Ondo, Centrifuge, Maple, and TrueFi, are actively working in the RWA sector, effectively bridging real-world assets with the crypto market. Furthermore, financial giants like BlackRock and Franklin Templeton are successfully managing government bond funds. While the performance of the much-anticipated Ethereum ETF has been lackluster, it's important to note that RWA has captured nearly 70% of the network, solidifying its dominance in the blockchain space. Through these data points, we can gain a glimpse into how smart money views interest rates and what scenarios they are considering with real estate. Despite the heated debates on whether or not these assets are substantial, traditional financial institutions are already conducting transactions using blockchain RWA. While some may argue whether Ethereum will fail, it continues to dominate the RWA tokenized government bond market, holding over 70% of the market share, firmly establishing itself as the top predator in the blockchain network. Likewise, while there is ongoing debate about which RWA coin is the leader, Whether it's Ondo or Centrifuge, all RWA coins are successfully linking different real-world collateralized assets with the crypto world, achieving what was once considered impossible. To summarize the economic indicators from August, the manufacturing sector is not performing well, while the services sector is doing fine. Despite worsening employment, GDP growth remains steady. Inflation has been controlled, but remains a potential threat. Therefore, a gradual interest rate cut, rather than a drastic 0.5% or 0.75% cut, seems more likely. Given the stable progress of the election race, there's little reason for the Democrats to take risks. Additionally, a smoother rate cut has historically led to a stronger market rally, as seen in the CCC High Yield Index option-adjusted spread. RWA-related data indicates that bond traders are exiting the market in anticipation of rate cuts, while capitalists expecting an asset market boom are using real estate as collateral for cryptocurrency purchases. We also verified the robustness of the blockchain RWA market and Ethereum. In this rapidly changing market, the only answer is continuous monitoring. I hope today's content serves as a helpful reference for you in making informed investment decisions. Please watch the preview at the end of the video. Thank you.